This is the Hold Report for Thursday, January 15th, 2026. The setup is ideal. Ted Pick, CEO of Morgan Stanley. The gap between U.S. capital markets and civic stability widened significantly on Thursday. Wall Street's leading investment banks reported double-digit profit growth, driven by a surge in deal-making and trading revenue. Simultaneously, Donald Trump threatened to deploy active-duty military forces to Minnesota. The market is pricing in the benefits of the former, deregulation and volatility, while effectively discounting the latter to zero. For the banking sector, the policy mix has unlocked a lucrative environment for M&A advisory and trading desks. The Trump trade is delivering on its promise for the financial sector: higher fees, lower costs, and increased activity. Goldman Sachs. Net earnings rose 12% to $14.01 per share. Investment fee revenue jumped 25%. Morgan Stanley. Investment banking revenue surged 47%. Three factors are driving the investment banking industry's success. First, deal flow. In a more permissible antitrust environment, corporations accelerate M&A activity. Both banks reported increases in their deal backlogs. Second, trading revenue. Goldman's equity traders set a new record with $4.31 billion in revenue. Volatility remains a profitable asset class for the house. Third, headcount. These results were achieved through aggressive cost management. Wall Street banks cut 10,600 jobs last year, the deepest reduction since 2016. The sector is generating record revenue with a leaner workforce. Goldman's beat was aided by the sale of its Apple Card portfolio to JP Chase. The transaction allowed Goldman to exit a costly consumer experiment, while JPM's earnings miss earlier this week was partially attributed to the friction of absorbing the portfolio. In geopolitical news, North American trade unity is fracturing. Canada signed a wide-ranging trade and energy agreement with China today, signaling a significant foreign policy shift under Prime Minister Mark Carney. In response to U.S. protectionism, Canada is diversifying its economic alliances, courting Chinese investment in renewable energy and battery technology to cut reliance on the U.S. This move, spurred by the Trump administration's shift toward imperialism, undermines the Fortress North America trade thesis. If Canada becomes a conduit for Chinese capital, the effectiveness of U.S. tariffs and trade barriers is substantially weakened. The pivot comes as China cracks down on domestic high-frequency traders. The resulting liquidity spillover is pushing China's $1.2 trillion trade surplus into global markets, distorting asset prices from London real estate to South American infrastructure. In siege news, civil unrest in Minnesota has escalated following reports regarding ICE's recruitment negligence. Trump threatened today to invoke the Insurrection Act, which would allow for the deployment of federal troops to American streets. Meanwhile, Trump purchased $51 million in corporate bonds from companies directly affected by his administration's regulatory decisions. This trade aligns Trump's personal financial interests with the companies he regulates. Markets have historically treated protests as localized noise. However, the Insurrection Act represents a structural escalation. A transition to martial law would introduce a risk premium that current equity valuations do not reflect. In Taiwan, TSMC announced $56 billion in capital expenditure for 2026, citing sustained AI demand. This outlook pushed ASML past a $500 billion valuation. In the U.S., the AI build-out is hitting a physical wall. The White House and Northeastern governors are moving to force technology companies to fund new power plant construction, signaling the end of cheap power for data centers. In climate change news, Vail Resorts cut its earnings guidance, reporting snowfall in the Rockies is 60% below average. 2025 was Earth's third hottest year in recorded history as climate impacts intensify. Countries continue to burn record amounts of coal, oil, and gas, chop down carbon-rich forests, and build thirsty AI data centers, ensuring that the Earth will continue to heat up at an exponential rate. This multiplies the risk of dangerous weather and natural disasters as administration policies continue to aggressively roll back regulations, withdraw from international climate agreements, and prioritize fossil fuel production. Morgan Stanley's CEO describes the current landscape as ideal because it maximizes fee generation through disruption. But there is a breaking point. With Trump trading the debt of regulated companies, Canada pivoting to Beijing, the military being threatened for domestic deployment, and the earth breaking a sweat, the ideal setup for trading is looking increasingly like a stress test for the system itself.